So I'm here to just spend 15 minutes to talk you through TR Property Investment Trust and a bit more about the pan-European real estate equity market. So yes, Lisa, if we can keep going. So first of all, a little bit about who we are. Some of you may have come across TR Property Investment Trust, or even me. I've been around doing this job a long time. I've actually been working on the trust for just over 25 years. And I've been running it since 2011, but I'm certainly not doing it on my own. And I've also, we are within the team, which is pretty significant. There are 12 of us. We actually run about just over 2 billion of real estate equities and some physical commercial property in the UK, mostly Europe, but we do have an ever-growing global franchise as well. Next slide, please. As I said, it's very much not just me. There are a really solid team working with me, and many of them have worked with me for a long time. My fellow fund manager, Alban Lorneur, is a French national. He joined me in 2008. Joe Elliott, the finance director, has been with me all the way since the beginning, which is back in the 90s when we were started at Henderson Investors and then moved to Thames River Capital, and then subsequently Thames was acquired by F&C, Bank of Montreal, and now owned by Columbia Threadneedle. But we are very much a partnership. Thames River Capital LLP still exists. It is partially owned by the partners, partly owned by the managing partner. Looking more deeply at the team, plenty of analysts. We do buy research from the street, but we do the vast majority of the heavy lifting is done by ourselves. Paul Gorry, Aidan Bolton, Sander Bunk, who's a Dutch national. We do like to have lots of languages in the team as well. That's extremely helpful. And I would highlight George Gay on the physical property side. He's been with me for a long time, looking after the physical. We're very much focused, bottom-up focused. We do a lot of our own research, as I said, and we do, we kick a lot of bricks as well, because ultimately real estate, a small number of brains can manage an awful lot amount of capital and make good decisions or bad decisions. So it's very much about that, picking your management teams. Okay, next slide, please. And then maybe just to touch on the trust itself. It's quite big. We have net assets of about 1.1 billion, currently trading at a discount of nearly 10%. Now that's about double what we have been trading at for the last few years. It's definitely widened as properties become kind of temporarily, I think, unpopular. We can own physical property up to 15%. It's currently at about 7%, and that's a function of part of where we think the market, where value is in the market. We think it's very much in the equity market at the moment, and we do have some gearing, which I'll definitely touch on a bit later, and it's quite interesting. Now, in terms of performance, it's been a roller coaster. We had our best year ever in terms of relative performance, the year to March 22, where we beat the benchmark by over 900 basis points, and then this year has been much more trickier as the macro has very much overwhelmed the bottom up, and we've seen some pretty stunningly poor returns from our sector, but we'll come on to a bit more of that in a moment. So next slide, please. And then this is a bit more about track record, relative performance on the right-hand side. We're very alpha focused. We're very aware that investors can go and buy the ETF, the tracker of my benchmark. So essentially, I must deliver alpha in order to justify our existence. We have beaten the benchmark every year for the last 11 years. The year which ends at the end of March this year is looking a bit trickier. We're kind of in line at the moment, so it has been not as successful as prior years, but those figures are we're pretty pleased with those over a long term. Thank you very much. Next slide, please. And then getting into the heart of what does real estate offer you? Essentially, it's a value proposition backed by income, and hopefully income that's growing in line or better than inflation with indexation. And as you can see here, the trust has been a very steady deliverer of dividend growth. Current yield is this slide is out of date. We're just over 5% today based on the last full year's dividend. We did have a dip in our revenue during post-COVID, but we do have reserves, and the board have been totally happy to use a little bit of those reserves to top up, but we expect to be back to coverage this year. Okay, next please. And then, as I said, property is an income with a capital kicker. That capital kicker is coming through rental growth and also through yield improvement. When you're picking up a margin over fixed income, and that has been one of the difficulties in 2022. But what's really encouraging is where this rental growth is coming from. We're in a very strange environment where yields are rising because the cost of money is rising, but at the same time rents are also rising in many of our sectors, and that's a function of lots of things. It's tenant stability outside of retail, which you'll be familiar with, but really it's about the lack of supply of new space. I mean, if you want brand new offices in the West End of London or the centre of Paris or the centre of Madrid, Barcelona, you're going to pay a rent that was probably more than was paid in 2019. And then the final point is indexation. Indexation is everywhere, but you pick up different quantities of indexation in different markets. And that can range from as little as 1 or 2% up to full capturing full indexation, as we are in our Swedish names at the moment. So over the last year, that's been 8 or 9%. And then valuation, we really are trading at very significant discounts. So yes, next slide, please, Lisa. Thank you. And effectively, this is really showing you what's happened to the equity market. Our annus horribilis, worst performing GIC sector last year. Over the 12 months, we were minus 35, but from peak to trough, so February to October, minus 42. Big recovery since then. And I think there's then again, we've seen some weakness in the last couple of weeks on the back of these banking issues. But it's really interesting. And when you look at the next slide, please, on the discounts, you will see. This one is just showing you the performance of our world versus the stocks Europe. And again, a really broad underperformance that we think is unwarranted. So next slide, please. And it's unwarranted because our discounts to our asset values are now hitting GFC style numbers, and we definitely think that is just too wide. There's just too much pessimism around the place, and actually that's because whilst we've seen serious correction in prices, we're starting to now already see green shoots of stability in a number of our markets, particularly the likes of industrial, logistics, etc. Now, NAVs are backward looking. So this is the stock market very much predicting what is going to occur in the physical market. What is really interesting is that in comparison to, say, a decade ago, the valuation community, who have always been traditionally a bit valuing in the rear view mirror, a bit slow to adjust, they've been much faster. And in fact, the MSCI IPD benchmark, the physical property benchmark for the UK, or for internationally, but for the UK, the numbers in Q4 22 were the fastest correction ever, even faster than we saw in 2008. So this is very much the valuation community realizing that pricing has adjusted quickly on the back of the cost of capital, and they need to do so as well. So we are getting very much to a point where NAVs are correcting rapidly. We've still got these very large discounts to asset value, which makes the sector fundamentally attractive. Okay, next, please. And so where are we focused? On the right-hand side, on the left-hand side, you'll see our absolute exposures. We are there to beat our benchmark, and our benchmark, for example, does have a significant chunk of German residential. But when you look at the right-hand side, you can see that relative to benchmark, our overweight to, say, German residential, which has been a particularly weak format, is quite modest. In fact, it's very focused on one particular small cap company called Phoenix Free Deutschland. which owns only flats in Berlin. All of these flats, many of them can be sold as individual condominiums, which is unusual. And that company actually has a continuation vote. It's an externally managed vehicle in about 18 months, and is trading at 50% of its asset value. So we see that very much as a classic deferred alpha play. The way we look at the universe is through these 23 subgroups, and what we're trying to look at here is bunch companies together where the macro factors are going to hit them all at the same time, or both as tailwinds or headwinds, and then we're very much stock picking within those groups, and then taking those overweights and underweights accordingly based on our bottom-up stock selection. So it's and that is a tried and tested route that has worked for many years. Okay, next slide, please. And then just a sort of snapshot of where we are on the left-hand side. We are unashamedly continentally biased. We have more exposure to Europe than we do to the UK. Physical property, we've mentioned our physical property is only in the UK, and actually right now it's only 3 buildings. An industrial estate in Wandsworth, which has got a planning permission to go to be much more built, multi-story with office and residential above. We have the Waitrose up in Bayswater, an industrial estate in Gloucester. So just those 3 assets at the moment, but we're pretty confident about rental growth in those markets. And then turning onto the geography, very varied, but it's really all about, it is dominated by France, Germany, and Sweden. But we're sort of to some extent country agnostic, and I think that comes across in our bottom-up stock selection. So next slide, please. And then just sort of bringing it all together, we think that the point of maximum macro uncertainty is getting pretty close. Certainly, the additional level of jitters this week has pushed values of real estate down even further. But actually, whilst one always is looking for a silver lining on a cloud, I think it's quite possible that the economic slowdown and the reduction in the rate of inflation that central banks are so determined to deliver upon us and that needs to be delivered is potentially going to lead to peak terminal rate already being reached. We have had this significant yield expansion, and increase in reduced liquidity and bank margins have been widening. But really interestingly, the problems in the real estate sector are in the private market, where there's way more leverage. Public property companies are the most geared ones, might be at a 50, or some Swedish names at a 60% LTV, but the vast majority are in the 30s or even lower. And in fact, we've focused very much on companies that have swapped or hedged or fixed their debt out for long periods of time, but also have reduced their leverage down. You can very much see that in our portfolio construction. The key message is that so much of this is already reflected, but turning sort of more positively, we see very little sign of corporate distress. And in fact, we're not sure whether we're actually going to move into much more than a short-lived technical recession. We actually are seeing earnings growth. We are seeing top line growth. We've got plenty of companies who are delivering for us. There are some subgroups, such as German residential, where a number of these names have suspended dividends. But and they are very much in a problem category, and we very much avoided the worst of those. But at the same time, our logistics, our light industrial, our student accommodation, self-storage, some of our healthcare names, these businesses are continuing to deliver growth and have fixed debt, which is really, really crucial. So for us, we've suffered a cost of capital adjustment, but our fundamentals for many of our markets remain more than sound. And with that, I think I'll hand back to Ryan. So thank you very much, ladies and gentlemen.